When it comes to finance and investing, there's a bunch of rations and metrics. These metrics help us determine whether a company's stock is worth investing in or not. Among these metrics is the price-to-book ratio. It is a nifty tool that gives us valuable insights into how a company's market value is reactive to its book value. This value holds immense potential for investors seeking to make smart decisions regarding their investment portfolios. This article explores P/B ratio, meaning its formula, and how to calculate it. Moreover, it will provide a practical example to help it all make sense. So, let's dive in. What is the price-to-book (P/B) ratio? The P/B ratio, or the price-book ratio, is a popular financial metric that helps investors to evaluate the company's value. It compares the market price per share to the book value per share. Investors can determine whether a stock is overvalued or undervalued to its book value by using the P/B ratio. It's a valuable tool for investors who seek stocks trading at a discount to their true value. To calculate the price-to-book value, divide the market price share by the book value per share. You can find this information on stock tracking websites by looking at the company's balance sheet and outstanding shares. It's typically displayed under the Financials or Summary tab. How is price-to-book value ratio calculated? The P/B ratio is a metric that compares a company's current market value to its accounting book value. So, how is price-to-book value ratio is calculated depends on the company's market capitalization and book value. Market capitalization, it refers to the overall value of a company in the market. It's calculated by multiplying the current share price by the total number of diluted shares outstanding. It reflects the market's perception of a company's value based on how much investors believe it is worth. Book value. It represents the net difference between the company's asset value and total liabilities on the balance sheet. It reflects the value of the assets shareholders would receive if the company were hypothetically liquidated. Importantly, the book value is an accounting metric and not based on market value. We use the equity value instead of the enterprise value in the calculation to avoid a mismatch in capital providers. The equity value considers the leveraged metric, accounting for the company's debt. Usually, a financial company would have a market value higher than its book value. It is because investors' expectations of future growth influence equity prices. To calculate the P/B ratio, divide the company's market capitalization by its book value. The formula for calculating the P/B ratio is P/B ratio equals market capitalization, book value of equity. Alternatively, you can calculate the P/B ratio by dividing the company's latest closing share price by its most recent book value per share. These can be expressed as P/B ratio equals market share price, book value of equity per share. You can check financial websites, stock exchanges, or brokerage platforms to obtain the market share price. In contrast, the book value per share is derived from the company's financial statements, especially the balance sheet. To calculate it, divide the total book value or shareholders' equity by the number of outstanding shares. Note, generally, a company's book equity value is really lower than its market value except in special circumstances. P/B ratios in public companies. Determining whether a stock is undervalued or a good investment can be challenging, especially when considering the price-to-book ratio. It's not easy to pinpoint the specific numeric value that defines a good P/B ratio. Instead of fixing on a single number, establish some general parameters or range for the P/B ratio. It sets the foundation for further analysis of other factors and valuation measures. It provides a more accurate interpretation of the P/B ratio and predicts a company's potential for growth. Value investors have favored the P/B ratio for many years, and market analysts widely use it. Traditionally, a P/B ratio less than 1 has been considered desirable for value investors. It indicates a potentially undervalued stock that could be worth investing in. However, it's worth noting that some value investors have a more relaxed benchmark and may consider stocks with a P/B ratio of less than 3 as acceptable. This border range allows for more flexibility in identifying undervalued stocks. It gives investors a larger pool of potential investment to consider. Ultimately, the P/B ratio is one tool among many for evaluating stocks. It should be used with other indicators and analyses to make effective investment decisions.